Hey everyone, my name is Jack. Welcome back to the channel. Today I want to talk about the ever-mounting debt crisis, specifically for corporate debt, and how we might be getting into a bit of a corporate debt bubble. Maybe that's blowing things out of proportion, no pun intended, but the corporate debt crisis certainly is cause for concern, and it has really gotten a lot bigger since the pandemic has hit. Granted, this is something that's been going on for a lot longer before the pandemic ever began. Corporate debt has been continuing to be issued, and I want to take a look at some of the data here. Bloomberg actually released this article fairly recently talking about how there's a lot of investment grade debts or bonds being issued by U.S. corporations, $30 billion just very recently with a few companies. And I should clarify about what they mean about investment grade debt. That typically is the highest grade debt. We're talking something close to a U.S. Treasury. That's considered risk-free, although that's highly debatable if you ask me. The fact of the matter is this is lower risk debt. There's a very high likelihood, much higher than most other types of debt, that you're going to get paid back. So because of that, typically the interest rates are quite low on this debt, and that actually makes it very attractive for companies to issue it, since they can actually pay very little in interest, comparatively speaking, if they can make a pretty solid return. But anyways, investment grade debt is higher quality, generally speaking. On the other hand, we have junk bonds, which are typically much higher yielding debt because the company itself is a lot riskier, or it somehow has a worse balance sheet or worse projections in the future, to where a credit rating agency will say, hey, your debt is worth less than this other debt with an investment grade company, since the chance of you actually paying it back is a lot less. Therefore, you can't borrow at such low interest rates, or at least you shouldn't be borrowing at such low interest rates, because no one's going to actually lend you the money at those rates. As a result, investors in junk grade bonds typically have a higher expected return, but they also have higher risk as well of actual insolvency or bankruptcy, or actually not being paid back in full. So it should be hard for those companies to raise a lot of debt, at least at low interest rates, unless of course you can do something like issue your own currency and then buy your debt with that currency, just like the US government does. But I don't think there's a lot of companies that can actually do that. Anyways, let's look at high yield debt, since Bloomberg actually put together this very interesting chart showing the amount of high yield bonds, or junk grade bonds would fall into this category, over the last few years. It shows that this trend is not new. The blue line down here represents the year of 2018, and you can see that $200 billion of low-grade investment bonds were issued in 2018. And we're talking about high interest rate, low-grade, riskier types of bonds. So this isn't the investment grade that I was leading off with. This is high-yield bonds specifically. The following year, 2019, before the pandemic, of course, was about $300 billion. So a 50% increase just in that year from 2018 to 2019. But of course, we're not done there. Going into 2020, we saw an increase from $311 billion in 2019 up to $441 billion in high-yield bonds, junk-grade bonds, lower-grade bonds that were issued in 2020. So that's nearly a third increase year over year. And you can see we are very much off to the races in 2021. Already about $200 billion in high-yield bonds have been issued by U.S. corporations just in 2021, which is already higher than it was in 2018 in its entirety, and about 2/3 of the way to 2019. And I should emphasize that 2020 was already a record year for high-yield bonds, so the most high-yield debt was ever issued in the U.S. in 2020, and we're already well on to that pace and well beyond it for 2021 if this pace continues. Barclays says that they see an extremely benign default environment, meaning that it's unlikely. They think it's unlikely that there's going to be lots of defaults, or that the value of this debt's going to be trashed because of some sort of bad environment. You see that there's better expectations for U.S. GDP growth, so very rosy outlook for all of this new debt being issued. Now, I should address the elephant in the room, which is the Federal Reserve and really central banks throughout the world, which have printed so much money into the system, and it's found its way into all sorts of corners, especially into the stock market and other assets. But there's a lot more money swimming around is the point I'm trying to make here, which would make it theoretically much easier to take out new debt because there's just more money lying around. So looking at it in absolute terms like this, the amount of debt actually being issued is slightly misleading because it depends on the actual value of everything else in the whole market and what these companies are doing. So if a company is doubled and then it's issuing debt at double the rate than it was last year, then, you know, it's not like that's a huge difference. It's just the scale of everything has increased, which is something that could easily happen in nominal terms with all all this newly printed money. I'm not saying that's the case here, but I am pointing out that there is a lot of new debt, and I would certainly assume that a large factor that's driving some of this new debt creation is just all the money floating around, and you can get it comparatively cheap compared to a couple of years ago when interest rates were slightly higher at least. But that doesn't mean that the debt isn't inherently risky and that taking on tons of new debt is not without consequence. This adds risk to the system no matter which way you spin it. The more debt that companies have, the less likely they can actually get themselves through a short-term liquidity crisis because they have all these debt payments to meet. And when that happens, you get this sort of domino effect. Lenders stop lending. People can't get loans to fund their businesses, even if they may be solvent, and so on. You don't want that to happen. That's how really bad deflationary spirals happen, the bad kind of deflation where money is actually destroyed, debt is destroyed, you have bankruptcies. That's not the kind of deflationary spiral you want to get into. And that differs from the good kind of inflation that comes from an increase in productivity and actually making things better and more efficiently. Looking ahead, Bank of America says that May is seasonally the strongest month of high yield issuance, so we might see even more debt than we've already been seeing, at least on a rate basis. We're going to see maybe an increased rate in May. We'll see what happens exactly, but whatever the case, we're definitely on a very fast pace for issuing new high yield debt. We'll see how these companies actually use this debt, whether they actually invest it into new projects to try and grow the business, or whether they just use it to do share buybacks to maybe trigger some executive compensation packages, which has certainly been controversial over the last few years, especially because look at all this debt. It has to go somewhere, and if they can't invest it in a project or they simply don't want to, oftentimes it's finding its way back into share buybacks when companies are allowed to do it, of course. But anyways, that's all I've got for today. If you like this video, please like it since that would help the channel out a lot. And if you like this sort of content about finance and investing and all that great stuff, then definitely have a look around the channel. And if you like what you see, be sure to subscribe since I put out new videos every single week and wouldn't want you guys to miss out. And if you want to get some exposure to the high yield junk grade bond market for whatever reason, you can take a look at the affiliate links in the description below. Got a few brokerages down there, including Webull and Robinhood, which give you guys free stocks when you open up an account using those affiliate links. I get some free stocks as well. So it's a win-win. Go ahead and do that. And once you actually have those accounts open, if you want to go for some of this high yield junk grade debt, you can go buy some bond fund on it and have at it. Hashtag not financial advice. But until next time, take care.